Welcome to PowerBrief, your daily financial intelligence briefing. This week opens with three things colliding at once: a fresh escalation between the U.S. and Iran that's moving oil and stocks, a Fed chair who won't tip his hand on rates just as bank earnings season kicks off, and a crypto market that's whipsawed from a 21-month low to a sharp rally in the space of 2 weeks. Let's go through what's actually happened, one story at a time, with sources. Over the weekend, the U.S. and Iran exchanged another round of strikes. According to CNBC's reporting, U.S. Central Command launched strikes described as targeting Iran's ability to keep attacking international shipping through the Strait of Hormuz, after an Iranian attack on a container ship in the strait left it ablaze and a crew member missing. Iran responded by striking U.S.-linked targets across the region, including reported strikes near Kuwait, Bahrain, Jordan, Oman, and Qatar. The market reaction was immediate. Brent crude climbed roughly 3 to 4% in Monday trading, at one point nearing $79 a barrel, while U.S. WTI crude rose a similar amount. That's a meaningful move for a single trading session, and it reflects just how sensitive oil markets are to anything happening near the Strait of Hormuz specifically. Bloomberg and CNBC both note that the strait typically carries something like a fifth of the world's oil traffic, so any real threat to that route gets priced in fast. Equities moved in the opposite direction. According to Yahoo Finance's markets coverage, the S&P 500 was down around 0.3% and the Nasdaq fell about 0.7% in early trading, while the Dow actually ticked up slightly, roughly 0.1%. Energy producers like ExxonMobil, ConocoPhillips, and Chevron were reported higher before the opening bell, which makes sense given the move in crude. Iran reportedly declared the Strait of Hormuz closed until further notice, though U.S. Central Command rejected that claim, according to reporting from finance and news outlets covering the story. This also puts real pressure on an interim peace agreement that had been signed last month after roughly 60 days of negotiations, aimed at reopening the strait and winding down the conflict. That deal's future is now in serious doubt. Worth being precise here. Oil price moves like this are a direct market reaction to a live, developing geopolitical situation, not a forecast of where prices settle once things stabilize. And as of this recording, the situation is still unfolding. It's also worth understanding that this isn't a single clean escalation. It's been a back and forth for weeks. Reporting from late June described oil prices actually falling as more tankers exited the Strait of Hormuz and mediators worked to hold a ceasefire together, even as analysts warned at the time that persistent supply risk could still spark a rebound. Then, in early July, reporting describes oil jumping again after fresh attacks, and separately, after the U.S. threatened further strikes and floated reimposing a naval blockade. A few days after that, prices reportedly eased around 2% as mediators again tried to prevent a full return to war. Now, as of this week, we're back to another spike following the weekend's exchange of strikes. That pattern, de-escalate, spike, ease, spike again, is itself the story. This is a market pricing in a conflict that keeps almost stabilizing and then reigniting, not one that's moved cleanly in a single direction. Away from the Middle East, this week is also a big one for U.S. monetary policy and corporate earnings, and the two are colliding in an unusual way. Fed Chair Kevin Warsh is delivering his first semi-annual monetary policy testimony before Congress this week on July 14th and 15th, according to Yahoo Finance's economic policy coverage. At an earlier appearance, the ECB's Sintra Forum, Warsh reportedly declined to signal how the Fed will handle its upcoming July decision, while acknowledging that the inflation outlook had improved somewhat since the last policy meeting. Reporting describes this as part of what's been characterized as a genuine internal debate, sometimes described in coverage as a family fight, over whether the Fed tightens further or holds steady later this year. The market's own pricing reflects that uncertainty. According to reporting cited in multiple outlets, futures markets have been pricing in a meaningfully higher chance of at least one more rate hike before year-end than they were just a month earlier. Some estimates put it above 50% for a hike as soon as the September meeting. a sharp jump from where those odds sat at the start of June. None of this is a prediction on our part. We're just relaying what the futures market itself is currently pricing, which can and does change week to week. This matters right now, specifically because of the timing. This week also marks the informal start of bank earnings season. JPMorgan Chase, Goldman Sachs, Bank of America, Citigroup, and Wells Fargo are all scheduled to report second quarter results, with JPMorgan and several others reporting Tuesday, July 14th, before the market opens, the same week as Warsh's testimony. According to CNBC's earnings preview coverage, investment banking revenue for the group could be up significantly from a year ago, and trading revenue is also expected higher, with analysts framing the quarter as an unusually favorable one for the industry, given strong Wall Street activity and resilient consumer credit. Investors will reportedly be watching net interest income guidance closely, along with whatever bank CEOs say on their calls about the rate path and credit quality, which puts Warsh's own testimony and the bank's commentary on a collision course this week. On top of that, June's Consumer Price Index and Producer Price Index reports are also due this week, which will feed directly into how seriously markets take the higher rate hike odds currently being priced in. Zooming out on the earnings side specifically, this quarter is being framed by analysts as an unusually favorable one for the big banks. The combination of strong Wall Street trading activity, resilient consumer credit, and what reporting describes as a long-awaited pickup in business lending. Investment banking revenue for the group could be up sharply from a year earlier, and trading revenue is also expected to be meaningfully higher, according to CNBC's earnings preview. Beyond JPMorgan on Tuesday, Morgan Stanley is scheduled to report Wednesday, and outside the bank specifically, this week's broader earnings slate also includes Taiwan's semiconductor manufacturing company, whose results are being watched as a signal for AI-related chip demand, along with Netflix and United Health. So this isn't just a banking story. It's the first real, broad read on how corporate America's second quarter looked, landing in the same week as a Fed testimony and a geopolitical oil shock. That's a lot of genuinely independent information hitting the market within a few trading days of each other. Turning to crypto, Bitcoin has had a genuinely volatile few weeks, and the moves go in both directions depending on exactly which window you look at. Unlike the oil story, which is being driven by a live geopolitical event, and the Fed story, which is being driven by a scheduled policy process, Bitcoin's swings here are largely a reaction to shifting expectations about what the Fed might do next, which means crypto, equities, and rates are all effectively reading the same jobs and inflation data right now, just drawing different conclusions from it depending on the asset. According to reporting compiled by 24/7 Wall Street and Yahoo Finance, Bitcoin spent the first half of 2026 grinding down from highs near $126,000 back in October 2025 to a fresh 21-month low near $58,000 in late June. A significant decline over that stretch. From there, prices climbed back, moving from roughly $58,250 on July 1st to nearly $64,000 by July 6th, according to that same coverage, with some reporting putting Bitcoin as high as the low 60,000s more recently. The rally has largely been attributed to a weaker-than-expected June jobs report, only about 57,000 new jobs added, which increased speculation that the Fed might lean toward rate cuts rather than hikes. Even though, as we just covered, more recent futures pricing has actually moved in the opposite direction toward higher hike odds. That's a real tension in how these two stories are being read by different parts of the market right now, and we're not going to paper over it. On the fund flow side, the picture is more mixed. Reporting indicates investors pulled around $4.5 billion out of Bitcoin ETFs in June alone, described as the worst month for those funds since they launched in early 2024, and enough to push the year's total ETF flows negative for the first time. More recently, spot Bitcoin ETFs reportedly snapped a 10-day losing streak, pulling in over $220 million in a single day, their largest daily haul in about 2 months, according to that coverage. Meanwhile, Citigroup reportedly cut its 12-month Bitcoin price target from $112,000 down to $82,000, while other base case forecasts reportedly still put Bitcoin trading in a $56,000 to $62,000 range until the Fed's month-end meeting. We're not making a prediction here either way. These are competing forecasts from different institutions, and they disagree with each other, which itself is worth knowing. For context on how sharp that earlier decline actually was, Bitcoin reportedly started 2026 trading above $93,000, then peaked near $126,000 back in October 2025, before spending the first half of this year grinding all the way down to that $58,000 low, meaning the coin gave back more than half its value from peak to trough before this month's rally began. That's the scale of round trip we're talking about, and it's a useful reminder of just how much crypto volatility can happen within a single calendar year, independent of anything happening in equities or oil. Stepping back, here's the through line across all three stories. This is a week where a geopolitical shock, a genuinely undecided Fed, the start of bank earnings season, and a volatile crypto market are all landing at the same time, and none of them are settled yet. On oil and the broader market, the key open question is whether the U.S. Iran de-escalation from last month's interim deal holds or breaks down further. That alone will keep driving crude price swings and, by extension, energy stock moves, independent of anything happening in rates or earnings. On the Fed and earnings side, Warsh's testimony this week and the bank earnings calls are going to be read together by markets. If bank executives sound confident about the rate path holding steady, that's one signal. If Warsh's testimony leans hawkish alongside strong CPI or PPI prints, futures pricing on that hike probability could move again in either direction. And on crypto, the split between the ETF outflow to inflow reversal and Citigroup's lowered price target shows there isn't a market consensus right now. Different serious institutions are reading the same data differently. We're not going to tell you which of these resolves which way. Nobody covering this story credibly is claiming certainty on any of the three fronts as of this recording. What we can tell you is what's actually scheduled. JPMorgan, Bank of America, Wells Fargo, Citigroup, and Goldman Sachs earnings on Tuesday, June CPI and PPI data this week, Warsh's congressional testimony on July 14 and 15th, and an ongoing unresolved situation in the Strait of Hormuz that could move oil prices again with very little notice. There's also a broader pattern worth naming across all three stories. In each case, the market is reacting to genuine uncertainty rather than settled information. The Fed hasn't decided, the banks haven't reported, the Iran situation hasn't resolved either way, and the crypto forecasts on the table actively contradict each other. That's different from a week where the market is digesting news that's already happened. This is a week where several major open questions are all still open at the same time, which is part of why you're seeing moves in multiple asset classes at once, rather than one isolated story dominating the headlines. If you're trying to prioritize what to actually watch, the CPI print midweek will likely move rate hike odds more than anything Warsh says directly, since Fed officials have generally been reluctant to commit to a path ahead of fresh inflation data. The bank earnings calls are worth watching less for the headline profit numbers and more for what executives say about loan demand and credit quality going forward, since that's a forward-looking read the market doesn't get from most other data releases. And on oil, the thing to track isn't the day-to-day percentage move, it's whether shipping traffic through the Strait of Hormuz actually slows in a sustained way. That's the difference between a headline-driven spike and a genuine supply disruption. Sources for this episode: CNBC's reporting on the U.S. Iran strikes, the Strait of Hormuz situation, and the bank earnings preview. Bloomberg's markets coverage on the Monday trading session and oil price moves, including its daily oil market analysis. Yahoo Finance's economic policy desk on Fed Chair Kevin Warsh's testimony schedule and market rate hike pricing. The Motley Fool's preview of JPMorgan's earnings kickoff, and 24/7 Wallstat. And Yahoo Finance's compiled coverage on Bitcoin's price action, ETF flows, and Citigroup's revised price target. As always, we've tried to attribute every specific figure to the outlet that reported it, rather than presenting it as our own independent research. We didn't verify the underlying trading data ourselves. We're relaying what these outlets reported. Links to the original reporting are in the description. That's this week's Power Brief. We'll be back with the next update as these stories develop. Subscribe for daily market analysis.